As an entrepreneur, managing your business's finances goes beyond just tracking expenses and maximizing profits. One of the most crucial aspects of entrepreneurship is understanding your taxes. A well-managed tax strategy can save you thousands of dollars, and one of the most effective ways to lower your tax liability is through tax write-offs. Tax write-offs, also known as deductions, reduce the amount of income that is subject to tax, ultimately lowering your overall tax bill. However, many entrepreneurs overlook some key tax write-offs that could significantly reduce their taxable income. Whether you're a freelancer, a small business owner, or a startup founder, it's essential to know which deductions you might be missing. In this video, we will explore the top 10 tax write-offs most entrepreneurs forget and explain how to take advantage of them to save money and improve your financial situation. 1. Home office deduction. Why it matters. Many entrepreneurs run their businesses from home, but many are unaware that they can deduct a portion of their home expenses related to their business operations. What to do? If you use part of your home exclusively and regularly for business purposes, you can claim the home office deduction. This can include a percentage of rent or mortgage payments, utilities, insurance, repairs, and even depreciation of the home. Tip: to qualify for the home office deduction, your workspace must be used only for business activities. You can choose between the simplified deduction, a flat rate per square foot, or the regular method, a percentage of home expenses. 2. Startup costs. Why it matters. Starting a new business often involves various costs that can add up quickly. The good news is that many of these expenses are tax deductible, but many entrepreneurs fail to track them properly. What to do? Costs such as market research, advertising, legal fees, and other business formation expenses can be written off. The IRS allows you to deduct up to $5,000 in startup costs for the first year of business, with any remaining costs depreciated over 15 years. Tip: keep detailed records of all the expenses involved in launching your business and consult with your tax professional to ensure you maximize these deductions. 3. Business meals and entertainment. Why it matters. Entrepreneurs often overlook meals and entertainment costs incurred while conducting business. This write-off is commonly forgotten, but it can have a significant impact on your bottom line. What to do? The IRS allows you to deduct 50% of meal costs associated with business activities, such as meetings with clients, potential clients, or business partners. This also includes meals while traveling for business purposes. For entertainment, the rules are stricter, but certain expenses can still be deducted if they are directly related to business activities. Tip: to ensure you're maximizing this deduction, always keep receipts and document the purpose of the meal or entertainment, including the people involved and the business discussions that took place. 4. Business use of your car. Why it matters. If you use your personal car for business purposes, you may be able to deduct a portion of your vehicle expenses, but many entrepreneurs fail to track their mileage or other vehicle-related expenses. What to do? There are two methods for deducting car expenses: the standard mileage rate or the actual expense method. With the standard mileage rate, you can deduct a fixed amount per mile driven for business, while the actual expense method allows you to deduct a percentage of your car-related expenses, fuel, maintenance, insurance, etc., based on the proportion of business use. Tip: to maximize this deduction, maintain a detailed log of your business-related trips, including the date, miles driven, and the purpose of the trip. 5. Professional development and education costs. Why it matters. Continuing education is essential for most entrepreneurs, especially in an ever-changing business environment. What many entrepreneurs don't realize is that education-related expenses are often tax deductible. What to do? You can write off costs related to courses, certifications, conferences, and other professional development activities directly related to your business. This includes tuition, books, supplies, and even travel expenses for educational purposes. Tip: keep records of all courses, seminars, or workshops you attend, including the costs involved. Ensure that the education directly benefits your business, as the IRS typically doesn't allow deductions for courses that don't help you maintain or improve your skills for your current business. 6. Insurance premiums. Why it matters. Insurance premiums are a common yet often overlooked expense for many entrepreneurs. These premiums are tax-deductible if they are associated with protecting your business. What to do? You can deduct premiums for various business-related insurance policies, including liability insurance, property insurance, professional indemnity, and even health insurance for employees. If you are self-employed, you can deduct premiums for your health insurance as well. Tip: be sure to track all premiums for insurance policies and make sure that they are specifically related to your business needs. Consult a tax professional to confirm which types of insurance can be deducted. 7. Depreciation of business assets. Why it matters. Entrepreneurs often forget about the depreciation of business assets, which allows you to deduct the cost of certain assets over time. Depreciation can add up to significant savings, especially for businesses that invest in equipment, furniture, or real estate. What to do? If you purchase assets such as computers, office furniture, machinery, or even commercial property, you can depreciate these over several years, spreading out the deduction across the asset's useful life. For certain assets, you may be eligible for Section 179 expensing, which allows you to deduct the full purchase price in the year of purchase. Tip: keep track of the purchase date and cost of all major assets, and consult with an accountant to understand the depreciation schedule in Section 179 options for your assets. 8. Retirement contributions. Why it matters. Entrepreneurs often neglect the tax advantages of contributing to a retirement plan. Contributions to qualified retirement plans, such as a 401k or SEP IRA, can significantly reduce your taxable income. What to do? Contributing to a retirement plan not only helps you save for the future but also provides immediate tax benefits. You can deduct contributions to retirement plans for both yourself and your employees, depending on the structure of your business and retirement plan. Tip: explore retirement plan options available to self-employed individuals and small business owners, such as a solo 401k or SEP IRA. These plans allow for higher contribution limits compared to traditional IRAs. Why it matters. Sometimes, you may not be able to collect on outstanding invoices. However, if your business suffers from bad debts, you may be able to write them off as a deduction. What to do? If you have a business debt that you've written off as uncollectible, you can deduct the amount from your taxable income. This is especially useful for service-based businesses that may experience issues with clients failing to pay for services rendered. Tip: keep detailed records of your efforts to collect the debt, such as written notices and communications with the debtor, to support your claim. 10. Marketing and advertising costs. Why it matters. Many entrepreneurs miss the opportunity to deduct the costs associated with marketing and advertising their business. These expenses can add up quickly, but the good news is they're fully deductible. What to do? Marketing and advertising expenses, including digital ads, social media campaigns, flyers, brochures, and website costs, are all tax-deductible. These expenses are typically categorized as operating expenses and can significantly lower your taxable income. Tip: keep a record of all marketing and advertising expenditures, including invoices and receipts. If you hire outside vendors, make sure to track their costs as well. As an entrepreneur, tax deductions are a powerful tool that can help reduce your taxable income and increase your profitability. By understanding and taking advantage of these 10 often overlooked tax write-offs, you can ensure you're not leaving money on the table come tax season. From home office deductions to startup costs, business meals, and retirement contributions, there are numerous opportunities to reduce your tax liability and keep more of your hard-earned profits. The key to maximizing these deductions is maintaining accurate records, keeping receipts, and staying organized throughout the year. Consulting with a tax professional or accountant can also help ensure you're claiming every legitimate deduction available to you and staying compliant with the tax laws. With proper planning and attention to detail, you can optimize your tax strategy and free up more resources to reinvest in the growth of your business.